Welcome to Contra Guys. I'm your host, Todd MacSween, and today we'll be interviewing Philip MacKellar. For those of you new to Contra, Phil is an analyst and portfolio manager at Contra the Herd Investment Newsletter. He also manages the Vice President portfolio with Contra's co-founder, Ben Stadelman. Phil's been investing since 2004, and he's been with the company since 2011. And for those of you new to Contra, the newsletter's primary focus is on contrarian and value-oriented opportunities in Canada and the US. Phil himself writes for Seeking Alpha, The Globe and Mail, and blogs about personal finance topics at his blog, mymoneymoves.ca. So be sure to check him out there as well.
Well, thanks, Todd, for that introduction and for getting us on YouTube. We've had a growing number of subscribers ask if we're getting on YouTube, so I'm really excited to film this first segment of Contra Guys with you.
Excellent. Well, could you tell our viewers a little bit about the newsletter? Do you mind?
Yep. The newsletter is based in Toronto. We've been in business since 1995, and we have two portfolios. One of the portfolios is managed by Benj Gallender, and the other one is managed by Ben Stadelman and myself. Each portfolio typically has about 25 names in it, and there's a little bit of overlap, but not that much in the grand scheme of things. What we do is we focus on contrarian and value stocks. And what I mean by that is stocks that are beaten up, unloved, hated, and just disliked by absolutely everybody. So many people claim they're contrarian investors, and I think we actually are. I mean, most of our investments start out as deep value investments when we get interested and involved. So what we do is we will search for those high and low on North American exchanges, and when we buy or sell, what we do is we update our subscribers via email, and then they can decide for themselves whether the decision we've made also works for their portfolio and their financial situation. So it's quite a flexible service. And then after the email updates, which we send out when we buy or sell, we send out a copy of Contra the Herd as well. This is a paper copy, and it's about 16 pages long, comes out once a quarter, and in it, it reviews the noteworthy happenings within each portfolio. So the companies that have had stellar or crappy earnings, or some big news item like a takeover or something like that. So that's our deliverable in a nutshell. And I guess in addition to the newsletter and our email blast, we're going to start to get into YouTube content thanks to you as well.
Perfect. Yeah, we're excited. This is terrific. Okay, well, maybe we'll start out with a question about the macro. I personally struggle a little bit here with historic valuations, ultra low interest rates, and inflation starting to creep into the picture. I mean, how do you navigate this environment?
Well, I think it's quite hard. I think you've nailed quite a few aspects of today's market. Interest rates or long-term bonds are going up. There's talk of inflation increasing. We'll see if it happens. And valuations are high. And the way I think about that is, yes, valuations are definitely high for stocks, but they're high for everything else. Real estate's high, bonds are high. So I don't know what wins out. Do stocks continue to be a great investment because they're priced better than bonds, or does everything kind of compress and revert back to more standard valuations over time? And I don't know the answer to that. I'm not sure what will happen. What I could say is how I'm navigating it isn't really any different than what I usually do. I'm looking for stocks more or less from a bottom-up view, and if I see things I like, I'll be buying them. If I don't, I'll be holding cash. So needless to say, I'm holding a bit more cash than I'd like to at the moment. I'd love to be more invested, but the valuations just aren't giving those great deals to me. So I'm going to sit tight and look for opportunities when they come around.
Sounds like a good plan, yeah. So how has 2021 been for you guys?
In light of the macro environment, 2021 has been very good on the sell side. So in January, we had, I think, our busiest month on record. You can ask Benj, and he can tell you for sure if I'm right there or not. But I think what we did was we sold 8 positions, or we issued 8 sell releases, and then we bought 2 other names. And that's almost unheard of for us. I mean, our portfolio turnover is pretty low, so to have that much in 1 month is quite unusual. So since then, things have died down, but it was definitely a very busy start to the year, and just trying to take advantage of what is quite a hot market and sell some of the names that we've been holding for a number of years now.
Well, nothing wrong with taking profits, that's for sure. So I'm glad you've been able to capitalize on the macro environment. Okay, so moving on, as many viewers will know, there is a proposed shakeup in the Canadian telecom space with the merger between Rogers and Shaw. Do you have any thoughts on the proposal?
Well, I think it's great for Shaw owners, of which we are. The company has been held in the vice president's portfolio for a long time now, I think since 2010 or 11. So as investors who have seen it go sideways for the past 5 years in the mid $20 range, we're quite happy. And it looks good to us from an investment point of view. I think from a regulatory point of view and from a consumer point of view within Canada, though, it's a much more problematic deal. And I wouldn't be surprised if the kind of rumblings that you're starting to see out of politicians turn into something bigger where they either block the deal outright or force divestments or force something or another in order for competition to continue in this country. Because, as you know, the telecom landscape isn't exactly the most competitive landscape in the world. So the combination of the first and fourth largest player into one would definitely make that worse. So we'll see what happens. And I think this is why the spread between the deal at 40.50 and where it's trading now, call it $33, is so wide. I mean, that's a huge spread. And I think the market is telegraphing that this deal, as it stands right now, is unlikely to go through, or it could even just disappear and the government could just say no to it outright.
Sure, yeah, that is a huge spread. Have you taken profit then, or are you still in the position?
No, we haven't taken profit, although it certainly has been a discussion that we are going back and forth on.
Sure, okay. And in terms of the deal closing, what sort of timeline do you think?
I think in the Shaw press release, they said that the deal would close in the first half of 2022. So call it a year from now. So there's plenty of time for Shaw and Rogers to try and ram it through and make it work. But we'll see how it goes. If the federal government does require something, it could be longer. And again, the deal could just fall apart. The government could just say no to it. So we'll just have to see what happens and where things pan out from here.
Yeah, it'll certainly be an interesting one to watch. Okay, so Ryan, a longtime subscriber, was wondering about your thoughts on Hibbett.
Right. So for those who don't know, Hibbett is a retailer in the United States. They focus on footwear and their main supplier is Nike. We bought the name in 2018, end of 2018, at $15.01. And as Ryan likely knows, we're out of the position now. So we've exited it entirely. And we did that at $43.50, at $48 and change, and then at $55.50. And those sales occurred in late 2020 and early 2021. So the holding of that company was pretty good. I mean, that was quite a good return over the period that we held it. But like so many companies in today's market, it's continued to rally, and it's actually hit a high of over $75 in the last 2 months. It's come back a bit now, but it's been one of those companies that has just rocketed upwards. And I suppose you could say, in retrospect, we left a little bit too much money on the table for other investors, but hindsight's 2020. So I guess we'll move on and see if we can improve next time.
No kidding, that is a huge rally indeed. So is that rally unique within the sports and athletic wear category?
The rally that Hibbett has had isn't that unique. It's more or less in line with the big publicly traded peers. If you look at Nike, Dick's Sporting Goods, Big Five Sporting Goods, or Shoe Carnival, they've all seen similar rises. And one of the reasons for that is the big companies that have the big logistics and supply chains have been able to survive, and many of the small mom and pop shops or even mid-sized retailers throughout the United States have gone bust or closed up or don't have the online distribution mechanisms in place to make it work in a COVID pandemic environment. So these companies that have been able to weather the storm, have been able to sell online, have done well and the competition hasn't. So I would say Hibbett is quite standard of what you're seeing from the big kind of retailers in the US.
Sure, that makes sense. Okay. Well, moving on then, we have a few subscribers asking about Computer Task Group. Do you have any thoughts on that?
In general, I'm quite bullish on Computer Task Group. I started getting bullish probably a year ago now, and I tried to convey that in the January 2021 issue of Contra the Herd for subscribers. My kind of enthusiasm or current enthusiasm for the company really started when Philip Guidi took over as CEO, and this was in mid-2019, and he really started to shift the company in a more positive direction. And what I mean by that is a Computer Task Group has two lines of business. It has IT staffing and IT solutions. IT staffing is a lower margin business, and it's generally speaking been where they get the majority of their revenue. And Philip has recognized this, and he is now focusing the company almost primarily or exclusively on the IT solutions business, and it's starting to pay off. So that's what makes me fairly bullish about the name, and I like what he's doing, and hopefully he does a really good job. There have been a kind of rotating door of CEOs since the founder died in, I think it was 2011 or 12. So there's a lot of work that can be done, and I think Philip's the person to do it. And the other things I like about the company are the valuations. Despite Philip's efforts so far, they're still low. The balance sheet is debt-free, and I could see it being acquired at some point. It looks like a good tuck-in acquisition for somebody, or if a private equity firm wants to take a run at it, they can take it over, I think, quite easily.
Interesting. Okay. And have there been any attempts to acquire it?
Yes, there have. There have been two attempts that have happened in the recent past. So both by a company named Assurance Global Services, and both attempts were unsolicited. So Computer Task Group's board wasn't on side with either one, but the proposals happened in 2019 at $6, and then right before the pandemic hit, Assurance Global Services made another unsolicited run at the company at $7. So yes, there have been two attempts to take the company private by the same firm in recent history.
Interesting. Okay. And we have another subscriber wondering what your thoughts are on their latest earnings.
I think the latest earnings reflect the job that Philip's been doing. The revenues were down slightly. As you know, 2020 was rough for a lot of companies, so they had a hit there. But he increased earnings per share from 29 cents to 53 cents, which is a massive increase. He had similar success increasing cash flow from operations, and then free cash flow increased from 6 to 28 million or thereabouts. And that, to me, speaks to his efforts and his focus on the IT solution side of the company and really driving the high margin end of their business.
Excellent. Well, that's good news. Okay. Andy, a longtime subscriber, was wondering about Diana Shipping. Could you give us your thoughts there?
It's not considered a buy at the current time. The limit we have there is 225, and currently, or when I checked yesterday, Diana Shipping was trading around $3. So I don't personally consider it a buy using my methodology at this time. Other methodologies, it could be because it still has low valuations, but I'm a little cautious with Diana Shipping because Diana Shipping has a tremendous amount of operating leverage and financial leverage. And either one of those on their own can get you in trouble. But when both of them are together, this company, when it falls, it really falls. And when it rallies, it really rallies. So that makes me a little cautious on the name. And I like it. I think it's, generally speaking, one of the better shippers out there. But like so many in the space, it's just got that combination of huge operating leverage and huge financial leverage.
Yeah, it makes for a lot of beta, that's for sure. So staying with Diana Shipping for a minute, another subscriber would like to know if you plan on tendering shares if they continue with their tender offers.
We could. It will depend on what price the tenders come in at. We have participated in tenders in the past. In January 2020, for example, we participated in a tender offer right before the pandemic hit. But we'll just have to see what the terms of future tenders are like. And I'm personally actually expecting that they might come out with another tender in the near future because in mid-March, they sold a ship for 11 million bucks. And usually after they do that, what they then do is they go back and they buy some of their debt, or they buy some shares, or they do both. So subscribers could be looking out for the possibility of a tender in the near future.
Interesting. Okay, good to know. We'll keep an eye on that. What are your thoughts on the situation in the Suez? It's a pretty interesting situation that's developed there.
Well, the Suez is interesting to watch. It's been, I guess, quite a show the last week or two. There have been no direct impacts that management has flagged because of this. They haven't issued a statement or filed anything with the SEC saying they have a backlog of ships stuck or stranded on either side of the Suez. And if you go online, and maybe we can provide a chart for people, but there's a fleet map which Diana Shipping has on their website, and it shows the current whereabouts of all their ships, whether they're sailing in the ocean or whether they're in dock being unloaded or reloaded. And it doesn't look to me, just by looking at that as well, like there are any ships just waiting to get through Suez and they're going to be stuck up in that. What I would say, though, is that there are likely going to be ripple effects through the entire industry because of this. So even though there's no direct impacts for Diana, it's very likely that some shipments somewhere will get delayed or transferred or something because of this situation in Suez.
Yeah, it's very interesting. I wonder if utilization rates might increase as average trip lengths increase with the Suez out of commission. Shippers are often paid by those chartering them at day rates, so perhaps we get a little bit more profitability out of some of them that aren't caught up in the debacle.
It could, though they also will have their cost for each day that they're sailing, so the margins will probably come in pretty similarly for the shippers as they're going along.
Good points. Okay, well, let's move on to Major Drilling here. We have a subscriber wondering about Major Drilling and its outlook.
I think Major Drilling has a fairly good outlook, and it's had a fairly good year in the past year. In the latest quarter, for example, revenues were about 100 million versus 80 or 81 million a year ago, and the net loss that the company recorded this time last year was nearly 10 million, and this year it's only 1.5. So things are going in the right direction for Major Drilling. And I would also say the quarter that just passed, so those numbers I just referred to, pertain to the months between November and January. And that, historically speaking, has been their weakest quarter because major miners and junior miners are generally not doing a lot of work over Christmas. It's just when they are reassessing, figuring out what they want to drill in the year ahead. And most of the projects they have are put on hold during the Christmas season. So that's a good sign of what's going on at Major to see that good of a performance during their weakest quarter.
Yeah, no, definitely. Okay, and the outlook on a go-forward basis?
Oh, right. The outlook, I would say, is good. The outlook is driven by two things. On the base metal side, it's driven by infrastructure spending, the rollout of electric vehicles, and the demand that that's going to place on the economy or on commodities. So things like copper, rare earths, lithium, nickel, all of those things will be in high demand, and Major Drilling is well positioned to help explore and suss out those deposits for miners. And then on the precious metal side, over the past 10 years, the reserve life of gold companies has declined about 35%. And over that time, the mine life has fallen from about 20 years down to 10 years. So even if gold stays kind of in its current funk and doesn't do anything, gold miners need to replace their reserves. So I'm quite bullish on Major Drilling because of those two features going on at the company.
Fair enough, that makes sense. Yeah, I mean, speaking of EVs and infrastructure spending, I guess, Biden's, $2 trillion infrastructure spending program, that's likely to help this bullish outlook, would you say?
Yeah, if it passes, of course. I don't know if it will pass. Who knows? The Republicans certainly aren't in favor of it, or that appears to be their position at the moment. And I can see that they don't want to go along with spending this big. And they already kiboshed the last spending. That was 1.9 trillion. So why would they go along with this? And it is a huge price tag. There's no doubt. 2 trillion is a massive amount of money. And for me, the really interesting takeaway I had from his proposal as it stands right now is he wants to increase the electric vehicle charging infrastructure in the US to about 500,000 charging stations by the end of the decade. And I went on the Department of Energy website, and it says there are 41,000, 42,000 charging stations now. So if he does that, that's a massive increase, and that's a huge amount of copper and other metals that goes into the EVs and then the charging stations he wants to build. So I think that's very bullish for major drilling as well.
Okay, and then we have a number of subscribers asking about Aegon. Is that something you can speak to a little?
Well, that's a great question because it's always got something going on, and it's just been a stalwart. It goes back and forth and back and forth, and it just can't seem to get traction. And Benj has been on record a number of times saying the reason it can't get traction and it goes back and forth is because it's a very hard insurance company to assess and understand. It has multiple divisions in countries on almost every continent, and because of that, it's very hard for analysts to wrap their head around it and for investors to get excited about it. And it appears that the new CEO, Lard Fries, he was hired in May 2020. He shares this view, so we're quite happy about that. And since he's taken over at Aegon, he has streamlined the operation quite significantly. He's deleveraged the balance sheet somewhat, and he's cutting costs quite aggressively. So instead of having a confusing web of subsidiaries everywhere, he's going to focus on 3 core markets, which are the UK, the US, and the Netherlands, 3 growth markets, and then he's going to amalgamate the kind of asset management business they do under one umbrella. So it will be a much more streamlined and focused company. And from a shareholder point of view, we hope that increases earnings per share, makes it easier for other investors to understand, and also makes it easier for analysts to evaluate and come up with numbers for any given quarter or half-year numbers that they release.
Sure, yeah. Sounds like some smart moves. So you mentioned 3 growth markets. Which are those?
The growth markets are Brazil, China, and then the countries of Portugal and Spain on the Iberian Peninsula. So 2 obvious growth markets in China and Brazil, and then Portugal and Spain, good established insurance markets within the European Union.
Okay, yeah, good to know. And Lard, do you think he has the industry experience necessary to pull off the turnaround?
I think he does. He is an industry veteran for sure. He's been in the industry for decades. And prior to joining Aegon, he was the CEO at NN Group, which is another Dutch insurance company, very large insurance company. And if you go online and you compare the valuations of Aegon to NN Group, it's obvious which company's done better. And hopefully he can replicate the success that NN Group has had and bring Aegon's valuations up to where NN is. And that would make us as investors very happy. And I think that's why he's the man for the job, because he's got a track record at a previous company in the same country, in the same field, and of similar size.
Perfect. Well, let's hope he can pull it off. Okay, we have a question from the web on Cameco. Do you still own it after this rally?
Yes, I still own Cameco. It's been quite a nice rally so far the last year or so, and at the current time I have no plans to sell it. So I'll continue to hold it for the time being. I wrote in the January 2021 issue of Contra the Herd that I actually expected some sort of pullback here because I was looking at it, insiders were starting to sell, the valuations looked a bit high, and the uranium outlook or the price of uranium started to waffle a bit. So I looked at that and said, well, we could see a pullback here. I'm going to hold my shares for much longer, or I anticipate to, but I could see a pullback, and that hasn't happened. I've just been wrong so far, and it's continued to do quite well.
Yeah, it has rallied quite a bit. What do you think you got wrong there?
I would say I got a few things wrong. The first thing is a big timing item, and that is that the Supreme Court of Canada refused to hear the CRA's case against Cameco for a tax dispute that's been going on for over a decade now and tied up more than $2 billion. So it's a massive, massive tax case. And the Supreme Court of Canada basically looked at this and said, well, the lower courts have already ruled on this, and why are you here? They've already ruled on it, and your appeal doesn't make sense to us. So I think this effectively puts this case to bed, and the market obviously likes that. Now, what could happen is the CRA could come back and they could try for the years 2007 to 2014, that set of tax years, not just the 2003 to 2006 tax years, which is what the Supreme Court of Canada just ruled on. But my guess is that the Supreme Court at this point would say, well, we've already decided it's the same set of rules based on the same company and the same subsidiary and the same practices. So, go away. It's game over. You've lost. And that would be my guess as to what they'll do. So that's the first thing I got wrong. The second thing is that their competitors, Kazakh, Denison Mines, and Uranium Energy Corp, all started buying uranium on the spot market. And Cameco's been doing this for quite a while. I was skeptical of this idea at first, but it's sure mopping up a lot of supply out there and helping balance the market. So that's helping the company. And then the final thing is that the Japanese government seems to be recognizing that if they want to meet their carbon targets or their CO2 reduction targets, they're going to have to start firing back up more of their nuclear plants. And that would bring a lot more demand back into the market from a country that has historically been a very large nuclear producer. And I don't expect the Japanese will ever be gung-ho about nuclear again, but I do expect them to start taking a pragmatic kind of approach to how they reach their CO2 goals and how they power their economy. And it looks like nuclear is a good way to do that, and it looks like the Japanese government is starting to recognize that too.
Sounds like there's a few shifting dynamics in the uranium market at the moment. Speaking of which, did you hear that the UK government is looking to increase its nuclear arsenal in the coming years?
I did see that, yeah. If I remember correctly, they're going to add, or they have 180 now, and they're going to increase it to 250 or 260. So that, I don't think, moves the uranium market at all. And the first reason for this is that while warheads have very high enriched uranium in them, the amount of uranium in there is quite small. And then the second is that the US and Russians are withdrawing and decommissioning way more nukes on a yearly basis than the British are about to add. So I think if you go on Wikipedia, you can see what they currently have globally and where they're projected to go. And I think the US has 5,800, and they want to decrease that by 2,000 over the next 2 years. And then the Russians have like 6,400, and they want to decrease it by 1,000 over the next 2 years. So that's a much larger reduction than the British are about to increase it. And so for that reason, I don't see this moving the market at all in any way.
Yeah, it sounds more like just a headline than anything.
Yeah, it is more of just a headline than anything. Yeah.
Okay, well, moving along, we have a question here about Alpha Pro Tech, which is an interesting one in a COVID sort of situation. So what are your thoughts there?
Well, that's a great question, and it's a great company. It's one of the most fascinating companies out there. So for the viewers who don't know, Alpha Pro Tech has two lines of business. First, they make medical masks and medical garments. They manufacture them. And then second, they manufacture construction materials like house wraps or weather seals for houses. So they have two very distinct lines of business. And what we did was we purchased them in 2012 at $1.17. So nice, low price. At the time, we thought it was a great buy because it had a clean balance sheet, good insider ownership, and, dilution wasn't an issue. Income statement looked great. And then the real kicker was every time there's a health scare, this company just takes off because of its exposure to this medical manufacturing and mask manufacturing. So in October 2014, as many people will remember, the Ebola outbreak was in full swing. So we sold a good chunk at $3.34. And then literally a week or two later, we sold even more at nearly $7. And then that died down, and we held the remainder of our position until February 2020, when COVID really took off. And we sold shares at $7.65. And we thought we'd done a pretty good job. I mean, versus where we bought it at $1.17, that was a great win.
Yeah.
And in retrospect, we were a little premature because what then happened was the stock really took off. The chart, which we could put up for viewers, may show a high in the $20 range, but intraday it was swinging up to $40 at times. So it went absolutely crazy. And, we left a lot of money on the table for other investors because of that. But it's just so hard to say. How do you value hype? I don't know. And that's what was going on at the time. Just everybody wanted it because they're one of the few kind of pure plays on mass manufacturing. I would say now that I'm not going to say it's behind us, but now that we're moving through it, the stock has died back down. It's now trading back under $10. It's being added to the Russell Index, and as you would expect, the sales for this company have now gone through the roof. They've more than doubled in the past year, from just under 50 million to over 100 million, purely thanks to COVID and the demand that governments and companies and consumers have put on manufacturing medical masks.
Yeah, wow. And I mean, do you think you'll ever own it again, or what are your thoughts there?
Mm-hmm. I would love to own it. We'll see. Has to get lower for sure before we consider buying it again. Though, because of this dynamic that it has of shooting through the roof when health issues arise, it does make it attractive for that reason. So I would love to own it again, and we'll just see if we get another run at it at some point here. Fingers crossed.
Yeah, sure. Are there any other companies that are similar that we should be watching?
Yes and no. There are other companies like it, but there aren't any companies that are as purely leveraged to mass manufacturing. 3M, for example, manufactures tons of masks, way more than Alpha Protect does. But 3M is a sprawling industrial with divisions everywhere. So the impact that something like COVID will have on its bottom line or its revenues is fairly negligible, and it doesn't move the stock. There are a few other smaller players, but again, none of them are as kind of purely focused on mass manufacturing like Alpha Protect. So they're a little bit unique in that regard.
Okay, well, moving on to a more sort of broad question here. I mean, where do you hold cash in this low interest rate environment?
Yeah, it's a super difficult situation, and that's a great question. What I do with my non-registered Canadian money is I park it in a high-interest bank account like Motive Financial or Tangerine. Sometimes Tangerine has good rates. And then if I have cash sitting in registered accounts or on the US side and in US dollars, what I'll do is I'll park it in high interest trading accounts. There are many, many high interest trading accounts that people can choose from. And one good link actually that people may want to look at is a blogger. His name is Mr. Thrifty. So MrThrifty.ca is his website. And he recently wrote a blog which details all the high interest trading accounts out there that Canadians have access to. It has it for US dollar, for Canadian dollar, and it indicates which company provides it, what the interest rate is, and it's a pretty good resource. So I'm very happy that he's put it out there for people, and I'll try to send you a link for it, and you can put it in the show notes at the end, or maybe put a graphic on the screen for people, something like that.
Excellent. Sounds like some great resources. So thank you for sharing those. We have a question here from your My Money Moves website, and the question is, what discount broker would you suggest for new investors?
Well, we don't advise on anything pretty much. That's not what we're going to do. We don't know what your financial situation is like or what you want in the discount broker that you're looking for. What I would say though is that there's a great website called Service Corps, and for me it's the go-to resource to determine where brokers in Canada rank on different metrics like cost, speed of service, ease of opening a new account, those sorts of things. And you can go on there, Service Corps, and you can rank and get lost in the data for as long as you like. And they update the data fairly regularly too, so you'll get a very good sense of what you're looking for and what would work for you. And they'll have a resource there to provide you the answer. The Globe and Mail also has an annual discount broker review, but the data is a little more static. It's not as updated regularly, but it's another good resource. And they've been doing this discount broker review for as long as I can remember. So probably over a decade, you could find articles from the Globe and Mail on discount brokers. And Both those resources are great. What I would say though is I don't think the data in either case fully captures some of the dynamics which happened on the back end of these different brokers. And what I mean by that is some brokers use a third party to manage their back end office, and other brokers, like the big banks, they don't. They have their own third party. And in those cases, they are much faster at turning over really complex or detailed situations that can and do arise. So that's just something to keep in mind. When I sometimes look through these rankings, I just think to myself that they're not quite capturing some of the more nuanced issues that investors can face.
Great. Okay, some great thoughts there. Not advice. Thank you, Phil. Appreciate that. A Seeking Alpha question here. Are you currently invested in any M&A deals like you were last year with Guyana Goldfields?
None like Guyana Goldfields. That was a M&A that I wasn't invested in prior to it happening, and I bought shares after the fact. Obviously, we're invested in Sean Rogers, but we've been invested in Sean Rogers for over a decade, so that wasn't a merger arbitrage that we went and found and then invested in. It just kind of landed in our lap. So I don't have any M&A deals at the moment that I'm looking at aside, or that I own aside from the Shaw Rogers potential merger. And that's not to say I'm not looking. I'm always looking. And if people know of anything interesting, they can give me a shout, send me a message, and I'll happily look at any M&A opportunity out there. I think they're quite dangerous. You can call it risk merger arbitrage, but they're also quite fun if you can get your head around what dynamics are going on. So I think it's a good opportunity, and I'm always looking for them.
Absolutely. Okay. Well, something to look forward to. Okay, well, thank you very much, Phil. Thanks for joining us. Really appreciate you coming on today, and I'm sure viewers are looking forward to more from you in the future. So.
Well, thanks again for setting this up. I've had a great time, and I really look forward to doing this again.
Okay, well, thank you everyone for joining us, and I hope you enjoyed the first episode of Contra Guys. There'll be much more to come, so stay tuned. Okay, until next time.